Okay, hello, welcome everybody to this week's edition of Selfwealth Live, the technical analysis edition. Here today with Jason McIntosh to my left. How are you, Jace?
Hey, Rog, I'm good. We've got a lot going on in the markets today, so it should be an interesting show to talk about stuff, look at some charts and look at some stocks, and a bit going on.
Yeah, there is a bit going on. Obviously, Australia coming down off its highs a little bit, so I'm looking forward to chatting about that. My name's Roger. I'm from Selfwealth by Syfe, and Jason's from Motion Trader. Obviously, if you don't already know, welcome to the viewers on the other side, both new and the guys that have been around for a while following us. We're getting some great compliments about this show, Jason. Just more around us and the technical analysis around their stocks. So I think people really appreciate that, and I appreciate that from you as well. Jason, all our learnings and teachings. Got a good general question from our clients, from one of our clients as well. So we'll get on top of that today. But otherwise, I think we've gone through most of the formalities. Let's go through the main formality, which is the disclaimer, please.
Yeah, and firstly, Rog, that's just terrific to know that we're helping, and what we're doing is helping people learn about stuff and going through their charts and looking at stocks and talking about how chart structure works, and I think that's the way we learn. We learn by listening and applying. We're applying through the show, so it's active learning, hopefully. So that's great, really good to hear. Now, everything today, general commentary only, doesn't take anyone's personal situation into account. And just quickly looking at our disclaimer, that just goes through that. I'm also not part of the Selfwealth team. My business is Motion Trader, as Rog noted. So my details are at the top: licensing, general commentary and all is in there. And beneath there, you'll see the Selfwealth disclaimer. Same thing, licensing, general commentary, all of that.
Fantastic. Thank you. So as most of you know, we're going to go through these three major markets that we offer at Selfwealth. That's the Australian, the US, and the Hong Kong market from a pricing chart and index perspective, and see where they're sitting at. We'll go through a viewer general question, and then we'll have a look at your tickers. Please put down one or two. We'll go through your main first one to start off with, and as it is, most of the time we're not going to get through the second one, but let's just see how it goes. Please feel free to put through your tickers, and I'll ensure I put the line in the sand when we can't accept any more. All right, Jace, let's have a look at this the Australian market. Thanks. How's it looking?
Okay, so we'll start off with our chart of the ASX 200, and we've got a big volatile breakdown in the ASX 200. We spoke about the possibility of more consolidation last week, and I thought the consolidation might have been contained within this range that prices had been in over the last couple of months. I thought maybe we could have seen prices track sideways along the moving averages. But instead, we've got a breakdown below the September and the November lows, as well as a break below this support at around 8,600, which went back to a previous all-time high from February. The other notable change is that the ASX 200 is below its 100-day moving average. So the red one is a 50-day moving average. Below there is the blue moving average, which is 100 days. So prices are now below the moving average. And that's for the first time since April. Back in April, when prices went from below to above the 100-day moving average, and the 50 for that matter. This is our first notable move below there since then. There were a couple of brief little excursions below the average over the last couple of weeks, but this is by far the more substantial of the breaks. I feel like there's an element of panic to the selling, as evidenced by this sharp decline on that was on Thursday, and then more selling coming through today. But is such a hasty exit from the market justified? And at this stage, I don't think it is. Of course, like there are individual stocks which may come back to exit points that need to be sold, but as a general proposition on the market, I don't think the market is at this point at a stage where a large scale retreat is justified. First of all, we have a break below the 100-day moving average, which we noted, and this in itself is not a bearish signal. The key the key will be how price action develops now it is below the moving average. Is it going to be a short, sharp trip below the moving averages like in August last year? So you saw August last year prices. Actually, that's July last year. Prices quickly declined, and then they quickly rebounded. So, like that, that's always a possibility. I'm not suggesting that is going to happen, but that sort of thing is a possibility. Or is it going to be more of a lackluster bounce? And that would concern me more. So if we got this initial sell-off, if we were to get a bounce over the next few weeks that looks something like this, so sort of like a lackluster bounce, doesn't really get much traction, really just moves sideways near the low. I think that would be more concerning, because that then would open the window of vulnerability that could potentially lead to a more significant fall developing. So I think that's the sort of price action to look out for, and that's where prices could shift from trading above these rising moving averages, where the dips are being bought, to trading below moving averages where rallies get sold. So that's something that we want to be able to monitor. At this stage, I'd say the break below the moving average is at the moment. I'd say this is an orange flag. It's a warning flag, and this means be alert. Know where the exit levels are on your stocks, but don't panic. I don't think this is a point of panic at this stage. Coming over to the equal weight, I think this provides an important part of the picture. Just look at the price action over the last few days. It's still trading above its early November low. Very different to what we're seeing in the actual ASX 200. It's not to say that it's not going to trade lower, but at this point, it's holding together quite well. So this tells us while that the ASX 200 is pulling back, or the broader market is pulling back at this stage, the equal weight, it's just a pullback to the moving averages, which is a normal thing in a bullish trend. So why are we seeing so much weakness in the ASX 200 when it's not coming through in the equal weight? And one of the reasons is that it's there's a lot of selling in the banks, particularly CBA, and you can see that in the financial index. I'll just quickly show you that this is the ASX 200 financial index. You can see this has been a significant fall over the last say week and a half. I thought up until we had this breakdown about a week ago, I had thought that this was like sideways trading along the moving averages. I thought this was going to lead to a breakout to the upside, and we started to get that break to the upside, and then it failed, and prices have now quickly made their way back below the moving averages. And these factors, like we also had these rising lows in place. So, like this is the thing with like looking at the chart structure. I think it helps us identify where probability may lie, like rising lows and trading along moving averages and pushing to the upside. They're all factors which I think put probability in favour of rising trends. But like nothing's ever guaranteed. That's the thing. Like, probability isn't certainty. It's just probability. And now we've got this break to the downside, just like in the ASX 200. I think it's too early to say that this is a lasting turn, whether this is a lasting turn or simply a longer consolidation after a large rally. We need to see more price action to sort of get a better handle on whether this is like a lasting structural change where we get stuck below declining moving averages. Need a bit more time to tell that. I think how prices respond now they are below these moving averages, Rog. I think that will tell us a lot. Like I said with the ASX 200, is it a V-shaped rebound, or is it a muted rebound that can't gain much traction? That's what I'm looking for now. And that would be the concern if it's that muted rebound, and that's when we can see a structural shift start to develop and maybe a longer lasting correction. But we need to see that price action come through. Just quickly back over the ASX 200. At the moment, this is just a 6% pullback from an all-time high. We've seen similar pullbacks over the last 18 months. You can see several of them on the charts. Some of them look quite unpleasant, and then within a few weeks or a few months, prices then made their way back up to new all-time highs. I think that's entirely possible that something similar plays out this time, but the breakdown does cause technical damage, and it's probably going to take some time to repair, should that be the course the market takes. So it takes a near-term upside certainly off the table, but it's at the moment, I think it's a monitor and see how this develops rather than jump in and panic at this point.
Okay, well, it's good to hear. Obviously, this is why we're here on the show as well, just to once again, we've been through this already this year where it started to pull back and it went back down to almost 20% before rebounding. But rather than sell all right now and everyone panicking, as what you hear in the media a lot right now, that's what we're here just to try and keep our nerves and see how this plays out over the next few weeks, right? The USA, it's not working. It's not happening the same. It's slightly different, the structure over there, isn't it?
Yeah, and just before we jump to that, it's like we get a few down days. It can get scary, but
Certainly.
a few scary days doesn't mean the trend has changed. And yes, I just draw attention back to some of these in the past. This is about 5 to 6% that was this about this time last year, about 11 months ago. There's this other one from July last year. There's this other one from April last year. Each of those at the time felt like a big deal. Like, let's just say, this. Just go back to the time. Here we are, and then kaboom! There we are, down below the moving averages. It's easy to get swept up in negativity, but often the negativity doesn't lead to follow through selling. Now, that's not to say it can't happen now, but it's to say don't just default to the worst possible scenario, because often the worst possible scenario doesn't happen. So we're trying to manage risk. Like, I've sold some stocks today, and some of them have been in big uptrends, and they came back to their exit levels. So it's like, well, I've got to sell these now. But there are other stocks which are well above their exit level. So I'm not quickly running out and selling them today because they're not at their selling point. So I'm shutting down risk where I need to, but I'm also trying to see off what could be another temporary pullback. And this big sell-off last in March, April, much of my portfolio remained intact. I didn't sell it, and I benefited from this great rally out of there. But you can only benefit from the great rally if a great rally eventuates. But you can only benefit from a strong rebound if you don't unnecessarily sell things you don't need to sell. Going over to the S&P 500. So last week we spoke about holding off on new purchases and possibly cutting back on leverage, and I think that remains the case. Remains the same story now. I'm not interested in buying this dip just at the moment. I want to see it gain a foothold and start to lift. And I'd certainly be uncomfortable running leverage at the moment. I think the risk isn't so much with the chart structure that we have here for the S&P 500. I think that remains positive at this point. We've got the moving averages continue to rise. It's a 1,500-day moving average, and price has mostly been above those moving averages. So that meets the criteria for a bullish trend. And it's certainly what we have at the moment. Just looking at this chart on its own, it's certainly not bearish price action. I think the vulnerability is in the declining participation. This is something we've spoken about previously. And we can see this playing out in the equal weight. So this is the S&P 500 index. Let's go over to the S&P 500 equal weight. And so this is where the largest stock is ranked the same as the 500 stock. So NVIDIA and the 500 stock weighted equally. And what we have here is now this broke to a 3-month low on Monday, and more importantly, it's broken out of this. It's about 2 months, about a 2-month trading range. You can see prices just been back and forth within this range for a couple of months. They'd been coiling up along the moving averages, and I thought the odds favoured a break to the upside. But as I was saying, odds are odds, but doesn't mean it's going to you're going to get the winner every time. now we've got this break to the downside. Now, it's possible we don't get follow through selling, and maybe this turns out to be a false break. We don't know. We just got to wait and see. But it's something I think to monitor closely, especially now the equal weight is below its 100-day moving average. You see the blue line, the 100-day moving average. You can also see the lack of participation in an indicator, and we've looked at this indicator in recent weeks as well. So this is showing the percentage of Russell 3000 stocks, so that's a broad measure of the US market, the percentage of Russell 3000 stocks above their 100-day moving average. And this indicator's been declining for a number of weeks now. So you can see these numbers on the side. That's percentage. So as this it's showing the percentage of stocks above the 100-day moving average. So it's currently sitting at 37%. You see 37%. It was up at 80% in August. We've had this erosion during the last couple of months. And now we've been discussing this decline in recent weeks, and that's been appointed to the current consolidation. As I just said, 37% on Monday, only 37% of stocks above their 100-day moving average. I think the key to ending the current pullback is to see this indicator get back above its own moving averages, or get back to at least above 50%, where you get more than half the market above its 100-day moving average. We need to see, basically, I think we need to see more stocks above their 100-day MAs, and that means more participation. But until then, I think we're probably going to see this pullback continue. Whilst there are fewer and fewer stocks above their 100-day moving average, it points to that vulnerability and that I think probability of lower levels in the near term. But that doesn't mean it has to be a crash. It can be a pullback without being a crash. Crashes make headlines, but they're reasonably rare. I don't think the odds favour a crash at this point in time. Every time I turn on not quite every time, but I've turned on the news a few times in the last few weeks, and there's talk of bubbles. It's if this is a bubble crash event, it's been the most well publicised bubble crash probably in history. So I don't think that's where we are. Anything can happen. We've got to manage risk, but also we got to keep our heads too, and just know where our exit levels are, and play by the rules we decided on when times were good, and when things get rough, that's when we really need to stick to our process.
Yeah, I totally agree, and I've read a lot of stuff actually on socials around you're either an investor, a professional investor, or trader when you don't get emotional about following your rules, right? And this is the time which is going to test us all, right? Where we're going to be hitting our stop losses and whatnot, and whether we're going to stick with it or whatnot, right? So professional or not, I know you are, Jace. So let's move on to Hong Kong, please. That'd be great. Thanks.
Okay, so over to the Hang Seng. And prices got up towards their October high last week before just pulling back on Friday and into Monday. This possibly sets up the maybe a trading range developing between the October high and the October low. Maybe some sort of like sideways contracting range along the moving averages could start to take shape. And maybe there's several more weeks of consolidation to happen. But overall, this remains an uptrend. Got the rising moving averages. And I think the odds do favour we ultimately see this resolve to the upside. It's yet the path of least resistance still does seem to be up, albeit within a state of consolidation. Going over to China, and again, prices pulling back towards the 100-day moving average. But the underlying structure here, it still remains bullish. What I like about the latest price action just over the last maybe 3 or so weeks is that it's been holding on to these gains off the October low. So see the October low came back to the 100-day moving average, had a strong rally, and now we've got this sideways consolidation going on. So it looks like that dip's being supported. We could get I think I think this could be shaping up as a good test for the resilience of this trend in Chinese stocks. Like if we get some further pullbacks in the US market over the next week or so, and if China can hold the line around the 50-day moving average, well, then I think that could continue to lay the framework for another rally. Uh, but look, let's see how the price action develops. Although I think at this point we need to say that this trend remains in place, uptrend. The uptrend remains in place.
Okay, fantastic. All right, let's move on to just a general question, Jace, because we're speaking a lot about how, well, not in Hong Kong, but or China, but in Australia, how we've gone below the moving averages. Why have you chosen those two 50 and 100 moving averages over your time?
Look, there are all sorts of moving averages we could use, and a lot probably depends on your time frame as well. Like some people might like to use, like say, a 10 and 20 or 10 and 30-day moving average, something which is faster moving, and nothing wrong with that. That can work really well. I'm looking at the market not so much from a short-term trading or a day trading perspective. I'm trying to take in a medium-term perspective. So with my own portfolio, with my motion trader stocks and the motion trader service, I'm looking for trends that might last, 1 to 3 years. And 50 and 100-day moving averages, I find they're responsive enough to move reasonably quickly as conditions change, but they're not so responsive that you get a big week and they're flipping from bullish to bearish and vice versa. So I just like that extended time frame. As I say, there's nothing wrong with using longer. Some people like to use a 200-day moving average. That works well also. It's a moving average is really just it just helps us take out the noise from the share price and focusing on what's the underlying trend, or is there even sometimes moving averages kind of move sideways, so there's no underlying momentum. Um, and also keeping it, I like to keep it fairly simple. I look at some people's charts and they might have 4, 5, or 6, or even more moving averages, and that I just find that confusing. I don't know where to look, and every time the share price moves, it's hitting a moving average somewhere. So what do you do? It's like so. Two moving averages I like, and I like that medium term time frame. Although they're not special numbers, we could use 40 and 80, and we could use 50 and 110, or 60 and 120, and they're going to give similar sort of outcomes. But it's about finding what you want to use, being consistent. Don't go, oh look, 50 to 100 doesn't quite give me what I want, so I'm going to move to 45 and 110. Look, that's the price I want, so I can, it doesn't work like that. I think it's find what you want to use, be consistent, and nothing wrong with shorter or longer. It's just what suits what you're after.
Yeah, there's so many obviously moving averages, numbers you could use, but I think you've also tested these moving averages with your system. Is that right?
Yeah, I've done a lot of back testing in designing the motion trader system, and I wanted a process that was going to be active without being, triggering signals and changes of signals every other day, because it was just too responsive. That's the thing with the shorter term averages. You get more signals. You might get earlier signals, but you might also get more false signals, because you get breaks, which if you're using longer moving average wouldn't have happened, and that's not a problem. You just had to be comfortable with more exits. But in designing a service which is going to try and help people who have jobs doing other things and aren't focusing on the markets all the time, it's like I wanted something which was going to be uh, the people could use without having to be looking at the screen all the time and placing trades all the time. And for me, that medium term approach is using 50 and 100 days. And like when you do back testing, you want to see that the variables either side of it also are just as good. So that's why I say we could use 40 and 90, or 55 and 120, and they're going to be generally producing those similar outcomes. And that means when you get good results across a range of nearby variables, you've got robust variables. It's not just finding something which, okay, these two numbers work, but all the numbers either side of it don't work. So maybe there's just luck involved. You want to see that that consistency of positive outcomes across all the nearby variables.
Okay. All right. Fantastic. Good response there. Let's move on to our tickers now. Greetings, Sydney from Vietnam. I hope you're having a great holiday over there. Let's just have a look at PME, please. Start off with PME.
Yeah, look, like a lot of stocks, it's now below its moving averages. Moving averages have crossed. So this is certainly not a point where I'd be looking to buy, because the chart structure does take on an element of vulnerability when it's trading below declining moving averages. Just looking at how far below from its high is. So it's at the point where, so it's about 25% below its high. So from a trailing stop perspective, it's getting to the point where, and I'd probably be considering exit. I'd be using an ATR or an average true range trailing stop, like the motion trader stop is. It's using the stock's daily trade, a multiple of the stock's average daily trading range to set the exit point. So motion trader's got a. I'm pretty sure this is a motion trader stock. I haven't seen any exits yet, so the trailing stop is probably not too far away. If I had this one, I could give it a little bit longer, but I'd want to be aware where my exit point is, and if it breaches it, well, it's like I'll close it. I'd close it out. It can be frustrating sometimes when you get a sell off and a stop triggers, and then you look at it a couple of weeks later and it's back above the stop. But it's just that discipline of exiting stocks once they get to their exit point. I think it's important because we don't know. We don't know which stocks are going to clip our stop and then go roaring back up, and which ones are going to continue to march lower over many months. So it's I think know where the exits are and be prepared to take them should that need arise.
Okay, fantastic. Hi, Devender. Let's have a look at OCL, please.
Look, this is probably going to be a theme today, in that I think we're going to find a number of stocks are below moving averages, which are starting to turn lower. None of these will be a buy for me. I'm not interested in buying this sort of dip. I'm interested in buying the dip back to rising moving averages. Not interested in buying dips below declining moving averages. Now, maybe this. And give me one moment, Rog, because I've just got a warning that my computer's almost out of battery, so it mustn't be plugged in properly.
That's okay.
I just need to get that corrected.
Got a comment here, Jace, when you're back. I'll continue on with this one. Give
me a moment.
No worries. Are we all stuffed? Yeah, it's a good question. We'll yet to see. Let's have a look. I'll just paraphrase that, obviously. Check out Fear and Greed. Yep, I like that one as well. I'm just reading some of the general comments here. G'day, Bob. Seems to me the strong hands are shaking out the weak hands. Well, could be. Let's just see how this all plays out. Obviously, I know at least anyone who's watching this show hopefully becomes a strong hand, right? So.
Okay, Rog, I'm back. Just had to do some power problem solving. Which cord wasn't plugged in properly? All sorted. I won't be disappearing through power outage.
All good. Let's continue on.
So yes, look, maybe things turn out like they did back here in March, April. Bit of time below the moving averages and turn back up, but we don't know. We want to ensure we don't get stuck in this sort of situation where you get an ongoing decline and you get a large percentage drawdown. So I think it's at this stage I'd be able to continue to hold. Where are we? It's around that 25% mark. So on a wide trailing stop basis, it's probably right at that outer parameter of where it's a withstandable pullback. But I'd want to know where my exit point is. Really, probably much below yesterday's low, Monday's low would probably be enough to say, look, I need to back out of this stock.
Okay, fantastic. Let's have a look at the next one, which is BHP, please.
The mining stocks have been quite different. The mining index looks very different to the banking index or the financial index at the moment. BHP, it's kind of been in what I'd describe maybe as an emerging trend. So the moving averages crossed back in July, and it's been establishing itself back above the averages. Started to get through some resistance here. You see this blue horizontal, but now it's like back below the resistance, which became support, and it's like dipping back below the moving averages. I still think the potential for this emerging trend to be in play remains open. I'd be holding BHP if I'd bought it in recent times. I'd be continuing to hold it at this point. I'd have a stop loss, which was probably giving it quite a bit more room still from here. It's quite a bit different to those last two stocks we've looked at, in that it's only just come back towards moving averages, which are continuing to rise. But I wouldn't be in a hurry to buy just yet. I'd like to see it rebound and then hold on to its gains. And then should it do that, well, then maybe it could set up and provide an entry opportunity. But for now, it's like if I've got it, I'm happy to hold it for now, but probably not too much I'm buying at the moment.
Okay, thank you. Hi, Yuan. Let's have a look at WC8.
Well, this is really bucking the trend, and it shows. Look at our stocks on an individual basis, not just go, okay, the market's down, quick, I've got to sell my whole portfolio, because some stocks will be doing things which are quite different to what the ASX 200 is doing. If I had this, I'd 100% be holding it. I wouldn't be going, look, I'm getting nervous, I'm just going to sell everything. It's like, why would I be selling it? It's doing the right thing. It's moving up and the moving averages are rising. So I'd want to be holding it. Ordinarily, like, it could be like, like I could be looking at this, like, is this a buying opportunity here? But it probably requires a bit of a, do I want to put it probably needs like a 26% stop back to the 50-day moving average as volatility in the market. Maybe it even pauses and does some consolidation. So if I was looking at buying it, I'd probably be inclined just to hold off and see whether we do get a bit of a pullback in the consolidation, and then maybe looking at that as an entry point. But if I had it, as I say, I'd be holding it, wide trailing stop. There's no reason here for me to want to exit a stock which is looking like this.
Okay, fantastic. Let's have a look at, I believe it's Jefferson. So let's have a look at APA.
Was it APA?
Yep.
Again, it's trending. It's trending upwards. It's nicely above its moving averages. Look at what the ASX 200 is doing. This is just a modest pullback. It's looks no different to some of these earlier pullbacks, which all then resolved in higher levels. I'd be if I had it, it's not giving me a reason to sell. It's like why do I still have stocks in my portfolio from 23, maybe 23 or 24? Given that we had that big sell-off in March and April, surely that was reason to exit a portfolio. It was a terrible sell-off, and yes, it was, and a few stocks left my portfolio, but plenty more stayed in because they remained above their trailing stops. There was no need to sell them, hence I still have them now. It's like a stock like this. It's like, well, if there's no reason to sell it now, just because the market's pulling back doesn't mean it should be a sell event for everything, unless a stock, at least this is what I think, unless a stock gives cause to be sold, it should remain in a portfolio. There's no point selling things that don't need to be sold. And at this point, this remains an upward trend. Yes, that could change, but as it stands, trend remains up. Wide trailing stop. See if it continues.
All right, fantastic. G'day, KC from Canada. Hello. Glad to hear there's people from international parts, internationally watching us here, Jace. Let's have a look at QNC.
I'm wondering, this would be probably on the TSX, would it? It must be.
Yeah. Let's have a look on the TSX. Yeah, for sure.
Yeah, it's the trend remains up. It reminds me a bit of Drone Shield with the price action, where I'm always like, this is great when you get this hard lift off, but it's a concern when you get the almost as equally quick pullback and the dip's not bought. Not a stock I'd want to buy if I was holding it from lower levels. In at lower levels, I'm still in profit. I could continue holding it, but I'd be thinking like, where am I going to get out of this one if it does continue to deteriorate? I probably wouldn't want to give it much more room below the 100-day moving average. That would mean that'd be a big reversal from the highs as well. Like it's already down 50%. I couldn't give this much more room. I think it's been reasonable to keep it in play up until now, but it's now getting at the point where it'd probably be close to saying, look, I can't hold this much longer. It's when stocks come back quickly, they don't have that buying support that instead of buying the dip, it seems to be the rally's been sold. So I think the risk is that we see either a prolonged consolidation, like we saw back in 25. We got the pull back to the 50-day moving average, got a bounce, but then it just continued to lose momentum for many months before having another attempt at rallying. I think that's a possibility here. So not a buy, and I'd be close to an exit if I was on board.
Okay, thank you. G'day, Roberto. Let's have a look at MEI.
And as we often talk about, one more thing on this. Like say like there was a nice consolidation there in September. Maybe there was a buy potential to buy around $1.70. Once a stock's up 300 or so percent, and if you get that parabolic increase as well, always worth considering taking a bit off the table. Sell a fifth, a quarter, or a third, whatever it may be. Because often we see after a rapid 300 or so percent, we often get those sharp pullbacks. So that's why it can be nice to lock a little bit in up higher. Sorry, Rog, what was that one?
MEI.
Finding support at the 50-day at the moment. So this is an interesting contrast to our last stock, which had that really strong rally, but unlike the last stock, MEI's found support, found buying interest a lot earlier. Unlike our previous stock, which continued down low without getting that bid coming through. So it looks like there's some buying around the 50-day moving average. I'd be holding if I was on board. Wide trailing stop, I'd be back, probably giving it down to around maybe around, like I'd use a calculation, but just from I'd say it's around probably 14 cents maybe for a trailing stop. So it's giving it a lot of room, but it's a smaller volatile stock. I think it needs lots of room to potentially stay on a larger trend. Ordinarily, this would be where I'd think, like, is this a buy the dip opportunity? It's finding support at the moving averages. I don't know. It's I'm probably a little bit more conservative with just managing risk at the moment. I'd probably rather buy a rally off the averages rather than preempt it at this point. But I'd be happy staying on if I was on.
Okay, thank you. Hi, Yuki. Let's have a look at DMP.
Yeah, it's too early for a buy. Like Domino's has had this lengthy bearish trend. It's gone from below the averages to above, which is encouraging. I think the key now, it needs to become established above the moving averages. Moving averages haven't quite crossed yet, so it doesn't meet my criteria for an entry. So the entry criteria would be the moving averages have to cross a 15-100 day, and it needs to be, then after they cross, it needs to then trade at a 70-day high. So there's a few things that need to happen for this to be ticked off as a buy. Um, like you can see, there are a couple of other occasions in the last year or so where prices got above when we could have looked at it here and said, oh, very similar setup from below to above the moving averages. And I would have said, okay, moving averages are turning, they haven't crossed, need to see this become established above the moving averages and all the stuff I said a moment ago. But you can see that didn't happen. It fell before it became established. So like I wouldn't have been a buyer back in October 24, I'm not a buyer just here now. But that could change if we get if we see it start to move sideways, moving averages cross, then we get the break higher. Yeah, this could become a buy. Well worth watching. It's doing something different to the ASX 200 at this point. It's look, I think this is a one to continue monitoring with a bias towards buying it. Should we get the right setup?
I think this is a great example, actually, Jason, around having patience in waiting for those moving averages to cross over and seeing that consolidation happening and the break before just jumping in. And if you like this stock, then being Domino's, obviously, then it's just a good exercise in patience, isn't it? Yeah?
It's also why I like the 1500 days, because it does. They do take a little bit longer to turn around, so they can help see off. Like if we're using, say, 20 and 30 days, the moving averages would have crossed, and we would have we would have potentially bought into this failed rally. Now, that's not necessarily a bad thing, because we can have a stop loss and we can get out without causing too much damage. But it's just going to be more active because you're going to get more signals, and that's not a problem either. But not everyone wants a more active approach. Some people want to be able to move in and out of stocks, but they don't want to be doing so that frequently. So having those longer moving averages, delays entry signals, and just helps reduce portfolio turnover. It's not a bad thing to have more turnover, but it's just not what a lot of people want. So I think those for reducing the number of signals we get, 50 and 100 days work well, and it can help see off some of these false breaks that don't go anywhere.
Yeah. All right. Thank you. Let's have a look at Astro. Hello, GLM, please.
GLM, is that the one?
N for Nelly.
Ah, right. There we go. Lithium. Yeah, look, lithium stocks generally have had a resurgence of late. Look, this is a stock I'd be holding. Nice consolidation along rising moving averages. That often leads to breaks to the top side. We're talking about that. Like, doesn't always work that way. We talked about it with the bank, with the financial index earlier. How I was saying, look, you can get these setups where you think the odds favour breaks to the top side, but it doesn't guarantee it's going to happen. But here's an example where it's broken nicely to the top side. I'd be happy to hold this one if I was in it, and I'd probably not buy it at the moment. I'd probably look for, do we get a consolidation? It's like a little bit like we saw a similar stock just earlier. Again, you probably need a 25% stop. I've got that market volatility, so maybe we get a bit of consolidation, and that could set up an entry point. So I'd be very happy holding it, and I'd be watching it with the aim of possibly buying it should we get the right sort of consolidation. But yeah, look, I think there's certainly upside in the lithium stocks generally at this point.
Okay, thank you. Hi, Dennis. Let's have a look at AUE. AUE. Not sure if it's worth holding any longer.
Yeah, I had this stock myself, and I sold it a couple of days ago, and that's because I think it had run to the end of my time stop, so I give stock 60 trading days, and I think for my entry point, it had just passed that point. My entry, I can't remember offhand where it was. Yeah, it was somewhere up around at these higher levels. Uh, what did it end up being? Might have ended up being a 22% loss or something. Uh, it's yeah. Look, a couple of ways to play it. It's consolidating below these moving averages, which have turned and now trending down. So there's vulnerability to that structure, but it's possible it stabilizes here and then gets itself back above the averages. Um, one way to do it could be like if someone wanted to give it a little bit more time, we could use the low from early November and say, look, it breaks below 50 cents, so maybe having a stop at 48 cents. So look, it's currently 53. I'll give it to 48. If it touches 48, be done with it, and I'm out. Uh, or out at a slightly higher price now. Look, there's neither's right or wrong. It depends what's going to work best for the individual. There's always a risk when you're holding something below moving averages. They fall quickly, and that sometimes happens. But yeah, look, it's a tough one because you can look at the price action from February and say, look, it's like had a big run and it's having a proportional pullback. So maybe it is a case that this is just going to spend several months consolidating and then ultimately go higher. But given where I bought it and the time frame that I'd held it for, and I was underwater in it, for me it was right to move it on and do something else. Maybe I end up getting back in the future. It's not hasn't like got this clear bearish downturn at this point. It's a recoverable position, but does it recover? We don't know. It is that vulnerable time below the moving averages. So it's probably a close call whether it be held now or and give it a little bit more room, or but if someone's had it for long enough, there's nothing wrong with cutting it either.
Okay, fantastic. Hi, Neil. Cat has hit its stop loss early this morning and now bounced back, looking to sell towards the close today. Can you give a view on the chart, please?
Yeah, I sold mine this morning. I sold mine into the bounce back. So this has been a motion trader stock for a long time. The signal was back, might have been back in 23 or something. It's been a great trend. I've been on it for I don't know, maybe a couple of years, and the stop loss was where was it? It was around 510. So it was roughly say that was roughly the stop loss there. So interesting one. It opened below the stop, traded to a low, got quickly bought back, and I had a look at it once it got up to 5.30. $5.30. You can see where it is now, $5.02. As it started to come back down, I sold mine. I think I sold them about $5.09, $5.07. I think it was $5.07. So around about where the stop loss would have been. I don't use a live stop most of the time, so I was just watching it and manually sold them. But yeah, look, it's an end of a great trend. I opted just to sell them after, just say, look, it could have been a lot worse. Thanks very much for the bounce back, and just be done with it. Um, Look, I think there's a reasonable chance, this and other stocks, they have a bigger bounce back towards the moving average. But I didn't want to punt that it's become a large position because it's done so well. It's up a few 100%. So the risk of me punting the bounce back and being wrong and then having to sell it at $4.10 or something, I didn't want to take that risk. So I forewent the potential of a rebound to sell at a better level and just close it out with a great profit. I've given some back at the end, but that's just the way it goes. And yeah, it's a lot of technical damage done there. I think it would probably be a while before this stock could regather and rebuild and go on to new highs. And a lot of the time when these big trends end, they go through lengthy consolidations and pull back lower. So look, I'm comfortable being out. That's how I've handled it. It'll leave the motion trade. It leaves the motion trader portfolio today.
Okay, thank you. Hi, Brendan. If you can, let's have a look at BTC. Is it coming down? Is it correction or is it forming a downtrend?
Yeah, I sold mine a couple of days ago because I had this structural shift about a month back, starting to spend time below the moving averages, which were rolling over. And then last week not last week, it was early November, had a sharp sell off, made some new lows. I was watching the bounce back, and this was going to be the decider for me. It's like, okay, how does this bounce back? Because I was thinking, like, could we get another period like March, April, where it does try to make several new lows, but quickly snapping back each time and then getting back above the moving averages. I didn't want to be selling at this sort of equivalent level. So I was watching it here. So it had made several lows. It was like, okay, if you can get a foothold here and quickly get back above the moving averages, I can hold my position, which I bought. By the way, I bought it back in around April. So, I'd held it, I'd ridden, sat through some pullbacks. It was all looking really good. But then, not every trend kicks on. This has so far been one of them. The bounce back. Look at the bounce back to the rally back to the moving averages. It was a lackluster bounce. This is what I was drawing in on the ASX 200 earlier on. You get that lackluster bounce where the rally starts to be sold, and that's when the vulnerability comes in. So that must have been on Thursday when we could start hitting back down to new lows. It's like, okay, enough's enough. Structure's weakened. It's making new lows. The dip wasn't bought. The bounce was lackluster. So I sold. Of course, I'm happy I did because it's at lower levels. If I was holding it today, had I decided, look, I'm just gonna hold on just in case, I think I'd probably have to sell it today because I just don't like this structure. It's making lower lows. We have declining moving averages. The risk is there's a sharp down day. Now that may not happen. It could. This is the low and it quickly comes back, but if it does have a sharp down day and I'm in it, it's like, well, it's my own fault because I'd go, well, I could see the structure was changing. I should have done something about it. So hence I did. I think there's risk I think there's just a lot of risk with Bitcoin at the moment. It may come back, but the problem is, what if it doesn't come back? What if it does have that sharp down day or days? What do we do then? Does it then become a long-term hold? And say, look, okay, well, I'll just hold it long-term and see what happens. And, if that's the strategy, that's okay. But if the goal was to hold it for 6 to 12 months or however long it was trending higher, and then it ends up turning into a long-term holding because it's underwater and we don't want to sell, we don't want that. I think where that's sort of doing that with a portfolio generally, that's how we end up with these the lead in the saddlebag, the stocks which are down 70% and sit in the bottom of our portfolio and just frustrate us every time we look at them. So we don't want to get to that position. So we've got to take action when things are coming apart, but still at a reasonable level. I don't know the future for Bitcoin from here, but for me, it was best to step out of the game, maybe come back later on, have another look at it.
Okay, thank you. Hi, Taufik. Let's have a look at ILU, please.
And again, just reiterating, everything's general commentary. I'm not telling anyone what they should do with any of their stocks. Everyone make their own calls. I'm just talking about what I think of the structure. And I get things wrong. Look at the financials. I thought the financials were going to break higher and they're broken lower. But you can see when something's not working, you can see it's not working. So, had I tried to buy the financials when they were breaking higher, I could have sold them when they started breaking lower. So the idea is, yeah, sure, be wrong. No problem being wrong, but just, don't be wrong for too long, and don't let being wrong become too expensive. And when you're right, like cat, just let the thing run and just, make a few 100%. There's nothing wrong with being wrong. We want to try and assess what we think the probabilities are. What are the odds? Are they in our favour or against us? And if we get it wrong, that's okay. Just don't want to be too wrong. Looking at ILU, it is still an upward trend. The moving averages are they're generally still moving up. The 50 started to dip a bit, but maybe they're going sideways now. But prices come back to the averages. The part I don't like is the how quickly prices came back. They rallied really well, and this is when all this excitement was around rare earths, I think, and like some of the other ones like Linus, we've had these swift declines. If I was holding it, look, I'd probably keep holding it. Maybe I think it's a motion trader stock. I'd be using the motion trader calculated exit. But yeah, look, roughly maybe it depends where I got in as well. If I got in early as prices were breaking higher, I'd probably be I'd be around 550 thereabouts for an exit for a stop loss. Really rough. I'd need to look at my calculations, the motion trader calculations. But I wouldn't be buying it because I don't like that the dip wasn't supported on the way down. But let's see if it can build a base around these moving averages, because it maybe it builds a base around the averages and starts to push higher in the months ahead. I think it would be, particularly if we're in at good levels, it's probably okay holding for now. But yeah, not one I'd want to buy just at this point.
Okay, thank you. Hi, Wish. Let's have a look at Life 360.
Yeah, so this left the motion trader portfolio a few days ago. Maybe it was around Wednesday or Thursday last week. Yeah, I'd be if I held it, I would have been getting out too. I'd be getting out where that motion trader stop was. I think it was around that $39 mark. Yeah, I think the stop was somewhere around here. So I think often when a stock goes from above to below the moving averages, there's often a rebound. I talked a bit about this with Cat, and it's often that rebound. The rebound could be an opportunity to sell into the rally back to the moving averages. Certainly not a stock I'd be buying. I wouldn't be buying this dip. It's had such a big run. Look, I'd probably be more comfortable like getting out of this stock now, because the risk is that it does continue to come off, and then if we keep holding and holding and holding, the decision to sell can become harder and harder. So particularly if I'd bought it up near the highs, I'd definitely be getting out and going, look, okay, I'm now down 25%. I've just got to like cut this. It hasn't worked. If I was in from the lower levels, it's like, yeah, if I was in from lower levels, I'd be wanting to decide, okay, where am I getting out if this continues to come back? Do I sell into a rebound? If we get a rebound, I'd be thinking about my exit points, and I'd probably be looking to exit rather than hold on and hope that we get another that is, rather than hope that it's just like a temporary sell off and we get this quick snapback rally. That could happen. It's happened a few times in this stock. We get these periods below the moving averages and it snaps back. But nonetheless, it's not the sort of price action I'm encouraged to hold. It's the sort of price action where I'm kind of trained to exit. So I'd be looking for my way out.
Yeah, thank you. Hi, Charlie. Let's have a look at AHK.
Yeah, nice rally off the averages. Was a sharpish pullback, but now it's quickly got that snapback rebound. I'd be holding it if I had it. I'd be holding it. I don't want to buy it at this point, just because of all the general volatility in the markets. If maybe we get a pause and a consolidation, that could then, that consolidation. If we got price action like such, and these moving averages start to come up and it's trading sideways, holding on to its gains, maybe that sets up an entry point. But at the moment, I'd probably just watch it if I wasn't in it. But yeah, as I say, if I was in it, if I bought this breakout from consolidation in October, for instance, let it run and see what it does.
All right, thank you. Hi, Shumita. Let's have a look at ATV.
It's probably in the emerging trend class at the moment. Some positive signs, and that's gotten above the moving averages, and had some strong rallies, and the pullbacks from those rallies have tended to look fairly corrective, like sideways to slightly lower. Then you get a strong rally after that. This latest dip has sagged a bit more back to the moving averages, touch below, but now it's starting to rally off it. It's potentially an emerging trend. If I was holding it, I could hold it here for a bit. It's also like a 2-cent stock. So the volatility in these things is just crazy. So at current levels, just to say I'll risk it down to the recent lows, it's 38%. It's like this is what happens when you with these low price stocks. Not one I'd be buying, but look, I think whilst it's above the October and November lows, I could give the upside the benefit of the doubt and see whether something develops. Sometimes it does. There is some encouraging structure, some rising lows. Yeah, let's see if it can hold these recent lows from October, November, and really establish itself above these moving averages and push higher. There does have merit to the structure, but it's low price, and that inherently makes it volatile.
Yeah, thank you. We'll do one final one. We'll look at FWD, please, from Lloyd. Hello.
Yeah, it's what happens now. It's below these moving averages. It's been in a nice upward trend, and I think it really needs to get a foothold quickly, stabilize, and get back above the moving averages to keep this one in play. Pullback from the high so far is 22%, so it's within reasonable. It's still within reasonable pullback parameters, but it's a motion trader stock, so I'd be looking at what the motion trader calculated level is. But it's probably somewhere around $2.40. Back there, I'd be saying, look, it just hasn't worked. And it's time to protect capital. And there's nothing wrong with saying a trade hasn't worked. It doesn't mean you've done anything necessarily wrong. It's just like, well, sometimes they don't work. A lot of the time they don't work, and that's okay. So this is why I think it really pays to come to the stock market without a whole lot of ego, because I think a problem a lot of people have is they've got this need to be right, and we shouldn't care whether we're of course we want to be right, but if we get it wrong, it's not like an ego hit. It's just like, okay, it didn't work out, and cut the loss, move on to the next idea, and keep the loss small, relatively small. So I'd be looking at that with that sort of lens. If it comes back a bit further, it's like, okay, hasn't worked out, let's cut it. And if it bounces back after we cut it, well, so be it. But number one is got to limit the loss of capital. I just can't keep holding on just in case it continues to erode. At this point, I could give it a bit more time. but I'd be aware of where the exit point is and when I need to take action. If it stalls below the moving averages, which are rolling over, that would be another concern. Like I did with the ASX 200. If we get this sort of stalled price action, that just opens the vulnerability for lower levels. That hasn't happened yet. That's just something to be mindful of, that we don't want to see. We want to see a quick buying of the dip back above the averages. So let's see what we get.
All right, thanks for that. We'll finish up there around the individual tickers, and we'll just we'll get back onto this topic around moving averages just to finalise the show here. And Hadley's just asked, thanks for the intelligent analysis you give us, Jace. I agree. Further looking at the 50 and 100 moving averages, what timeframes do you use on the chart? Varies from long to short times.
So give me that question again, Rog.
So what timeframes do you use on the chart with the 50 and 100-day moving average?
Well, the timeframes is 50 and 100 days, isn't
Yeah.
it?
So what time frame are you using? Obviously, it's daily. I'll answer. It's a daily time frame.
So if we look at different time frames, we're looking at different moving averages. So if I were to change this to we could put it on a weekly, and now we've got 50 and 100 week moving averages, or we could go to an hourly, and we've got 50 and 100 hourly moving averages. So they're periods depending on what time frame you're looking at. I predominantly look at the daily chart. From time to time, I look at a weekly. Like I've been looking at the weekly chart for gold quite a bit in my Friday strategy sessions, and that's been helping identify what's been going on there. So the weekly charts can be useful, but for stocks, I'm predominantly looking at the daily chart. Nothing wrong with the other time frames, but it's just you can get yourself a bit confused if you look at too many. If you look at the hourly, and you might say, "Oh, look, this stock's in a downtrend." But then you look at a daily, and you just see, okay, it's just been moving sideways for 3 weeks, not a downtrend at all. But some people might be trading off an hourly chart, and that's I used to do that. I used to trade off 5-minute and 15-minute charts at times when I was looking at currencies and futures markets. So it depends what you're doing, what you're aiming to achieve, what time frame. But for this show and what we talk about, it's really and what I do with Motion Trader and most of my own portfolio, it's mostly a daily chart and that 50 and 100 day moving average combination. Not magic numbers. I always stress, I give the parameters that I use, and not magic numbers. You could use numbers, either side, and they're going to give you broadly similar outcomes. Not special numbers. It's just like you got to choose something. So I just go with round numbers that broadly work with what I'm trying to do.
Yeah. Well, thanks for letting us know around that. And obviously, you can find out a lot more about Jason's systems at Motion Trader. I'm looking forward to next week because we're going to have something special around that as well. So don't forget to join us next week. I think the saying of the day, Jason, I heard you say before, is don't be wrong for too long, right? And I think that's been a theme of a lot of stocks we've looked at today, right? So as always, capital preservation is important. And the more and more I read on social media, it confirms a lot of the things, well, from professional traders out there, on just being that systematic and being rigid in following your rules and not being too emotional about it. And obviously, this ties into don't be wrong for too long, because no doubt if this continues to go down, a lot of our stocks are going to hit exit points, and it's at these points where we test ourselves, and we have to test ourselves to see if we actually are following our systems, right? So
This is what I think is dangerous with high conviction trading or investing. I hear this. It's a popular line I see on email subject titles coming out from various places. 5 high conviction ideas. It's like it's great we've got high conviction, but high conviction can also see you fly a stock into the ground. And I've seen it happen before. I've seen prominent fund managers lose their jobs because they've had high conviction in stocks that they were wrong and they didn't want to be wrong. So they held and held and held and they got fired. And it happens. And so I'd rather be wrong but not too wrong than cling to the hope that I'm going to be right through high conviction and find that I've been bowled at the stumps and I'm down 90%, looking at a stock going, well, the market didn't agree with my high conviction. So it's it's another strategy. It's not a strategy for me. I'd rather admit defeat early and move to the next idea and then try and get the big win than steadfastly hold position saying, look, the market has to agree with me eventually. Because, look, I don't think the market has to do anything. It'll do what it's going to do, whether I like it or not. So, relatively small losses, except being wrong, it's not a big deal. And staying in the game, that is a big deal. You've got to stay in the game. And if you have too many high conviction losses, well, you've got to go and do something else because you lose your capital.
Yeah. Yep, great way to end the show. Thanks a lot, Jace, for your time again. Thank you, everyone, for joining us. Any final comments, Jace, or happy to
No,
close?
I think we've covered a bit for today. So that should probably wrap it up.
Very good. Don't be wrong for too long, right? So have a great week ahead, everyone, and hopefully all goes well. If not, we will catch you again next Tuesday at 12 o'clock Australian Daylight Savings Times. Have a good day. Bye bye.